Hey, welcome to the Aeromir Roundtable. Today is the 29th of April, 2020, and a special guest, Preston Girard. I've known Preston for quite a while. We haven't really talked much, but I've seen your name around in different venues. And Dan Harvey and I used to do the road trip trade, and Preston was a long time follower of that. So
Yes,
it's,
yes.
it's nice to have Preston here and as a guest speaker for a change. So welcome, Preston. Nice to have you here.
Thank you, Tom. I appreciate the opportunity very much. Thank you. All right,
And you can share your screen anytime you're ready.
gotcha. Let me go ahead and choose the right one here. There we go. And I'll make it in presentation mode here if I can, or slideshow. There we go. Do you see the first slide there?
I do, yep.
Excellent. Okay, well, thanks very much, Tom. I appreciate it very much for letting me present today. I've been watching presentations in this community for a long time now, and I've seen some really awesome, really great stuff, of course, and I traded the road trip trade for a long time. I'll talk about that a little later here. Excuse me. So I'm honored to be able to present myself here, and I'm humbled, honestly, to be amongst some of the best minds in this industry, certainly in the trading world and the options trading world, and I really appreciate the opportunity. So
Glad to have you here.
thanks, Tom. And if I hope you all can hear me okay. If not, let me know, and I'll push the mic a little closer or a little farther away, or whatever you guys need. So I'm Preston Girard. I'm a personal coach and mentor at Forma Financial, formafinancial.com. I work with Andrew Faldy over there, whom some of you might know or know of. And today I'm going to talk about my systems and volatility products, automated systems that I built and I've run and I've traded for a long time. I've been successful with them for several years now. Um, as well as the trading course that I recently put together at Forma that teaches how to automate and how to build these systems. And the systems are for going both long and short volatility. And short VXX was my first real successful system. I'll talk about that a little later too. We'll focus quite a bit today on long volatility because these systems are very powerful. They can capture huge profits during market crashes, which is why this presentation is called Volatility Profit Spikes. The presentation video at Forma for the course is called Profiting from Volatility Big Time, with big time in parentheses, because this is what it did for me in this last crash this year. And this is what it's designed to do. It captured huge profits from that big 35% S&P market crash. But it's designed as kind of a multi-purpose system too. It hedges portfolios. Long volatility is usually used for that, and it can make lots of money during deeper market corrections and pullbacks and sell-offs, and a ton of money during crashes. And it provides one more thing that I think is very important, and that is a profitable equity curve over time just on its own that will allow you to continue to build income even during extended bull markets, which is what it did over this extended bull market. So this is a pretty powerful system. I'm happy to bring it to you. I'll talk about how and why I built it, how I got to where I am, the journey that led me to building it, making it my main thing, and how to access the course and all of that today. So we'll start with disclosures. So this is for educational purposes only, of course, and we just recommend that if you are interested in these systems in this course, that you simulate. First of all, this is what I did when I started. You simulate. Make sure that it fits your personality, that you like it, you're interested in it, that you understand it, work on it, test it before you go out into the live environment. And if you do go out into the live environment with these systems, we definitely recommend the minimal risk allocation to it, just to make sure that you're being very prudent and safe with this stuff. So again, I'm Preston Girard, and I am a personal coach and mentor. That is one of the paths I've chosen as a trader. I've been a funded trader since 2014, which means businesses have given me money to trade for them. I know it's kind of nuts to think that would happen, but they have. And then I've been a consistently profitable trader since 2014, and that has mainly been because of my volatility systems that have helped me do that. I'm also a registered securities trader. So I'm a prop trader, a proprietary trader for a broker dealer in New York. In 2017, I took that Series 57, and not an easy test, but got through it and got registered. And so I've been trading prop for a while now. And as I said, so, personal coaching and mentoring and prop trading, those are the two paths I've chosen. When you get to a certain point in your trading, you can choose different paths. You can choose different things. You have a lot of opportunities. You can just continue to trade your own money. You can become a professional, trade for prop firms, hedge funds type situations. You can become an investment advisor, have a family office, trade family and friends. You can develop and sell strategies. You can offer trading services, etc. I chose to be a teacher, a coach, a mentor, and a prop trader. These are just the things that fit my personality. I write a blog about the process of becoming consistently profitable at formafinancial.com. I offer one-on-one mentoring. It's sort of personal trading growth. It's more about kind of mindset and finding things that work for you and then building on them. And that's kind of how I believe you become profitable. You find out what you do in the market specifically, and you get better at that and maintain focus on that and get stronger at that. I also join Andrew on the Wednesday group mentoring meetings usually, and sort of try to provide some value to that. And then I'm a prop trader, and the reason I continue with that is because I like to have a professional mindset in the markets. I like to, every time I go out in the markets, I like to, think professionally, keep myself accountable. It's sort of a way that you know, I, I, I keep it sort of career oriented. So it helps my trading when I do that. So there I am in the middle right there with the gray hair. Andrew put me right in the middle, obviously, to sort of, I think, to showcase my gray hair. He must have, because neither of these guys have gray hair, right? So, but anyway, so I'm the head of personal coaching and mentoring. And I really focused on making sure the course kind of followed this line of thinking, helping people build things that might work for them. I didn't necessarily set out to build strategies and sell them, but there are actionable strategies in the course that you can learn, you can build, and you can apply and run right away. Still, I see it as a training course because it teaches how to automate just your ideas, not only volatility but any ideas, just at a basic level, a level where you can get started even if you have no experience coding or programming, and then take advantage of the price behavior of certain products. So you can take your new automating skills from the course, whether you're a newer trader or you're experienced and looking for another skill, and apply it to other things. So it gives you kind of a world of opportunity and options. It's important to remember as I go along here that I'm not just trying to package something together and try to make a bunch of sales and sit back and not trade. I actually trade this stuff every day. This is my approach. I actually call it leading with my hedge, and I'll talk about that a little later down the road as we go along here. So who the heck am I, right? Who is this guy? I've never heard of this guy before. What does he have that's so special? Well, I kind of explained this in the beginning. Why am I here today? Well, I'm reaching out to newer traders and those who still are trying to become profitable. Experienced traders are included in that. About the automated volatility trading course that I built and is for sale now at formafinancial.com. It hedges portfolios, but also it makes huge profits during market crashes. During the last market crash this year, the 35% S&P sell-off, it made 460% profits. So it was a big event. Profitable equity curve during the bull market. So that's the other thing that I think may be almost the most important thing, is that it makes its own money over time as a standalone system. So that's a very powerful kind of thing. Now, volatility systems are powerful, but you can code other ideas as well. Like I said, you can bring in stocks and other ETFs, ETNs into ideas and automate those, code those and automate them, add a new skill to your set, because the course provides a foundation for coding an easy language, which is traded on the TradeStation platform. But also on multi-charts. You can take multi-charts, use easy language, hook it up to a broker like Interactive Brokers. You don't need any prior experience coding or programming. Like I said, you watch the course, you pay close attention. It gives you the basics on how to navigate the TradeStation platform. And I do it in the TradeStation platform in the course because that's generally the best user experience I've had with easy language. But again, you can use it on multi-charts. And then we look at pre-built strategies and code it and the code and how it's structured. Then we add the strategies to the charts. We code our own ideas. We test, we optimize for best results, etc. So it gives you the basics so that you can get started and actually do this thing. And also it's kind of a thing where we don't leave you alone, and that's kind of goes along with who I am. I'm not just going to try to give you something and okay, take it and good luck. I really want to make sure, and we do at Forma, that you guys, who, if you're interested, that you get that support, that personalized support. So there will be we're already offering a free month of group mentoring for purchasers. For Aeromir purchasers, there will be an extra month, so it will be 60 days actually of free group mentoring and personalized support to help you build out your volatility systems. I'll give you a link at the end of the presentation how to take advantage of that. There will be a deadline to take advantage of that, so I will give that to you at the end. So I believe this concept is pretty powerful. I'm hoping it might provide something really meaningful for traders, that it might even be a game changer, at least a very big boost and maybe a turning point in their journey, just like it was for me. So I'm going to talk about my journey a little bit. I started trading in 2011, right before the big sell-off. And basically I started trading because I work for a law firm, and I'm not a lawyer, but I'm just kind of a finance guy. And we decided at the time, hey, let's try to figure out, we need to start thinking about a retirement. So, and I said, well, I'll just figure out the markets. It shouldn't be that big of a deal. If these guys can do it, I can do it. And of course found out that it wasn't easy, that it was extremely difficult. But in the beginning, I started just basically trading earnings. I didn't know how to read charts. So I would bring in, I opened up an E-Trade account, and I just brought in, whatever stocks had earnings the night before, or the morning pre-market. And then I'd put them in a watch list with just volume and price. And when the markets opened up, if the price started to tick up or down and the volume started to tick up, then I would just buy or short. And so I actually didn't do too bad with that, believe it or not. I think it was kind of beginner's luck, but I was just kind of going with things that seemed like they were kind of in play, right? And that was going okay. I mean, it was kind of breaking even, kind of learning how to do it. And then the market fell apart. And I had started to buy like Apple and Google, thinking, hey, maybe I have a handle on this. And so I was long a bunch of stuff. And then, of course, the market sold off. And that's when I really started to struggle, because I kind of sat at my computer stunned, thinking, is this how the market acts all the time? Like, what am I going to do? So I kind of figured, okay, I'm going to have to go find somebody to help me, to teach me how to do this kind of thing. And so, I found this outfit that was working with E-Trade called Pro Market Advisors, and they taught me a real primitive sort of foundation of options and technical analysis. And it was helpful, but it was just the very beginning. And so I just began my strategy hopping career, which is what a lot of us do when we start, right? I mean, strategy hopping is when you're being inundated by all these different strategies that people are selling. And many of them, are successful strategies. I mean, it's not that they're lying about it. It's that a lot of times these people who are selling strategies, it may have worked for them, but for you, you'd have to really understand why and how they built them, and the different changing market environments, and understanding when not to trade them or when they're going to struggle, etc. So since you don't really understand that yet, generally, like me, you blame the strategy for the losses. So you're just always looking for that holy grail, that strategy that never loses. It's like, oh, you go along, maybe you win 3 months, the fourth month you lose, and oh, well, the strategy doesn't work after all, so you move on to something else. So most of us, if not all of us, go through this, right? Quit many times. It was very difficult. It's a hard process. One of the hardest things I've ever done is learning how to trade. And then in 2013, I strategy hopped for a while. And then 2013 was a turning point. I learned automated trading. It was actually Andrew Faldy who taught me automated trading. And he said, hey, do you want to learn this? And I said, oh yeah, it's another sort of skill. Maybe I'll start to do well. I don't know. So he started, we did some one-on-one stuff, and he was teaching me this. And then we got to a point where he said, okay, so, I've given you the basics. So what do you want to build? And at the time I had been, in technical analysis, I'd been looking at charts and trying to learn that. And there was this guy who had this virtual trading floor, and he was running this bang bang intraday strategy. And I was struggling to keep up. I learned later I'm not an intraday trader. So, but he was, he had this big following in his VTF, and everybody is like competing against each other. And I felt like I felt totally out of my element, but the guy was really funny. So I just like to watch him and listen to him. And I thought it was really interesting. One of the things he would always say is short the VXX, short the VXX. And he would make jokes about it, but he was really serious about, hey, just short the VXX. And I was like, what is he talking about? So I looked at his price chart and I noticed, wow, this volatility product, this product that attempts to track the VIX, just goes straight down. And so it was like, oh, that's why he keeps saying short the VIX. And so, I didn't really act on that for a while, but when Andrew asked me, what do you want to build? I said, well, how about shorting the VXX? So we put together a strategy, we put it in the chart, we didn't even optimize it, and we brought it up, and it was this beautiful, smooth equity curve over several years. And we were both like, whoa. And so it was sort of at that point that I went, okay, I need to start checking into this. I need to sort of start learning this. So I simulated it for a while. And I started to kind of, understand it and get a better idea of the product and why it acted the way it acted. And so this was really my first system that started to really make money for me on a consistent basis. And I started to really learn it inside and out and feel more confident with it. And then towards the end, about 2014, early 2015, I added long volatility to the short volatility system. So it would go both long and short. And so that is kind of how I began to do this volatility stuff. I was still learning market neutral concepts. I really, really wanted to be a market neutral trader. I just had a love affair with the idea of market neutral trading, with being a sort of a net seller and bringing in, premium. And I just thought it just was fun to me. And so I just really wanted to learn something and build something that, was making money and being successful in market neutral concepts. And so at the beginning of 2015, my main thing was volatility, both long and short, but I was still learning market neutral trading. And so then, of course, this is the beginning of 2015. This is the SPX. And so right before the big sort of China issue here, where people thought there was going to be a hard landing in China and you got this big downdraft, it was possibly the greatest period of market neutral trading that I've ever seen. Right? I mean, this is just a beautiful range to trade in. It almost didn't matter what you traded at the time. You did pretty darn well with market neutral. The rut was basically very similar, not as much in a sideways range, but definitely not. The ATR wasn't real high. It was just kind of going in this nice these little rangy patterns. So it was very nice. And at this time, I was in this no-touch butterfly portfolio. I had butchered, I think it was the mango. I'd gone through Sheridan mentoring and learned the mango trade, which is a iron butterfly. And I had butchered the heck out of it during 2014. So I sort of scared myself about adjusting. And so I was running this no-touch portfolio in these sort of at the money, broken wing butterflies. I called it my no-touch uneven butterfly portfolio, where I'd put these things at the money, not very much risk. I had several on at once. This one's in the SPX. I was in it at this point right before the big sell-off in 2015 for a couple days, and it had started to gather a little bit of premium. There was one in the rut I'd been in for about 5 days, and it had gathered some premium. And I was, you can tell from the the legs and the width here that it's just this broken wing, and from the graph here. And so I had 3 of these things on. I had just put this thing on that day, and I was doing fairly well. I didn't have a lot of risk. Most of the risk, like I said, was in volatility. And so, I was like, I was kind of getting a little more confident with, my market neutral. And then of course this happened in the SPX, and then it went all the way to the edge. It didn't lose a lot, but it was just all of a sudden like, whoa, something's different here. And so I took that off. And then of course the same thing was happening in the rut. So my butterflies were experiencing some adversity here. It wasn't terrible, but I could tell something was different. And I think I had some criteria where if it hit the edge of the tent, then I just take it off. So I took everything off. I just peeled everything off. And usually what I do is I'd peel this stuff off and then put new ones on right away. But I was like, nah, I think I'm gonna sit back and kind of see what happens. It feels a little different, and of course it's a good thing, because thank goodness for long volatility, right? As I sat there, this is the TradeStation platform, and this is UVXY. This is the leverage product. I'm using UVXY instead of VXX. I was going long and short VXX at the time, 2015, and this is that time frame here, what I was trading. But I'm using UVXY as a proxy for VXX, even though VXX is not leveraged, because I can't get historical data back to 2015 for VXX on TradeStation 10, this platform, because VXX matured. It's an exchange traded note, and it matured in January of 2019. So VXXB was issued in early 2018. The idea was that it would replace VXX once it matured, and that's what it did. Then once VXX, the original VXX matured, then VXXB basically just replaced it, and they called it VXX again. And so, but I can't get the historical data to show you exactly, but this is almost identical to what was going on with the long volatility and the short volatility. So I was going long and short, and I was kind of drawing down, okay, because it was, market neutral was doing fine, but with a volatility system, if you're just chopping in a range, volatility is neither really going up or going down. So you're just kind of, although it's more kind of drifting down with these products, with the negative drift, and I talk about that in the course, that these products have their own actual behavior as well. But this was basically drawing down. And so once I got into this long position here on the 19th of August, and I was taking my butterflies off, this is the first time I just kind of sat back and sort of let long volatility do its thing. And I was basically flat in my other stuff. And I was like, oh, and I just kind of watched the P&L roll in, and it was nice. It was like, whoa. And so that was kind of my first experience. Now, I had automated some gold and silver the previous year and kind of watched some of that do well. Excuse me, but this was the first time I'd experienced it with long volatility. So you can see I was kind of drawing down. This is the equity curve, and you can see this is what I've experienced kind of since I started trading 2014, 2015 in long volatility. I had to have the short volatility element at the time to get it to be smoother, because short volatility kind of smooths it out. So I'm going short and long at equal allocation. But it's kind of drawing down. This, by the way, does not go all the way back to 2011, even though it says it up here. It actually only goes back to about 2014. So it's not jiving with that number right there. But anyway, you start off down a little bit, right, on 19th of August, 2015. Going to the next slide. And then a couple weeks later, you're at $64,500, right? $67,000 you've made. $60,000 allocation every time you take a trade is what this is, what this system is. And so you made over 100% in a couple of weeks. So, experiencing that is pretty darn powerful and cool, especially when you've like, oh no, I've had to take off my other stuff. And I'm like, darn, I've lost in my other stuff. But then you get this kind of feeling and you're like, hey, I'm still in the game here. I'm like, and so the big thing was the crash of 2015, because of the long volatility element, made me profitable for the year. And that was really, really kind of a big time thing that happened for me. That was a happy event. But I still really wanted to be a market neutral trader. I really wanted that to be my main component. I just still had this love affair. So here we are with the road trip in 2016. And I remember, I believe it was very early 2016, and I believe it was capital discussions at the time, but but Dan Harvey came on, and it was just, I think, the regular kind of weekly meeting and I think I'm remembering this correctly. And Tom kind of asked him to just jump on and show what he'd been doing. And Dan Harvey came on and he started showing this trade that I don't think was being called the road trip. It was just him showing what he'd been doing. And as he was showing that, I was like, wow, that's the greatest thing I've ever seen. It's like that. I'd looked at all these different things up until that point, and I thought that is the most brilliant thing I've ever seen. So I started and then it kind of became the road trip, and the guidelines were posted, and then I started following that, and through 2016, 2017, I did very, very well with this. I mean, those markets just basically kind of went up. And so it was a really important thing because it was the first successful market neutral system for me. And that was a big deal. And I started getting better at options trading. And I wouldn't have gotten to that point without the automation and the volatility systems, without the success I'd had, because those things had allowed me to stay in the game, as I like to say, gave me the confidence to stay in the game. It's quite possible I may have quit for good if I hadn't have felt that kind of confidence of like, okay, I was able to put a successful system together, so maybe I can put together another one with a little patience, right? So maybe I can actually do that with market neutral. And then once I saw the road trip and started trading that, that's actually what happened. And so, this was really the second successful system that I had. And now I was going, and it was a big deal for me. And this is why, in my opinion, this is such an important idea concept, is automating volatility for newer traders or those struggling to become profitable. If you get a taste of success from something that fits your personality, and you start to really understand inside and out, it can be a game changer, because it can keep you in the market so that you can get better at the other things as well, and you can really start to build an approach. Okay, and that's why I believe it's so important. At the same time, I was also getting better at directional trading. I continued to look at the charts. And in 2017, I added a profitable swing trading system, because you remember 2017, it just went straight up. And at a certain point, I was doing fine in the road trip, and I was still trading volatility systems. I'd kind of put the allocation a little less in my volatility systems. And now I was like, man, this market is just going straight up. I need to just buy stocks, and I need to buy relative strength stocks, and I need to find really good trade plans for these ideas I'm having. And so it was really the first had this profitable swing trading strategy. So again, I benefited from the success I'd experienced with automating volatility, and then with the market neutral element. And now it was the beginning of three disciplines, volatility, market neutral, and swing trading with equities. And so even if I didn't really know it at the time, these became the things that I do. Every time I go out into the markets now, I go, what do I do? And these are the things I do. And I just focus on getting better at it. And so that was a really big deal. And then the Volpocalypse happened. And anybody who was trading during that time remembers that, especially if you were a market neutral trader. Okay. This was a really big turning point for my overall trading. I was still trading the road trip, but it really didn't matter what I was trading as far as market neutral at the time. A lot of traders I knew experienced big losses from this event. It was very difficult. And that's because here's the Volpocalypse and the SPX. It's a parabolic move. I mean, you were already going up pretty aggressively. This rally was pretty aggressive. This is why I was making money in my swing trading. And then, because I was just basically playing stocks against their moving averages. So it was like almost like, printing money for a while. And so, of course, that gets your confidence way up, right? So it goes parabolic in the first part of 2018 and then just drops like a stone. And of course, for market neutral options traders, that's possibly the most difficult market scenario, is going from short volatility with really strong direction to long falling volatility to really spiking volatility, and the direction is going really hard down. So that's a tough situation to be in when you're a market neutral trader. And at the time, here are my road trips at the time. So, I had about 6 of these things on at once. And that's what I was doing, is I was putting on about 6 at once. And I had kind of let these things all die out here at the edge, and, it wasn't the trade's fault. I'd gotten myself into this situation with these trades. I just let my positions get away from me. They all went way outside the tent on the upside, where they basically just died. So they were really just sitting ducks out here. And I had not done personally a proper assessment of the market environment and made the appropriate adjustments that would have kept these things viable, because I was just sticking to a rigid set of rules. And my approach at the time was really just, oh, well, I guess I'll just go through this losing cycle, and they might just lose a little bit. They'll stay out here. Maybe I'll expire them, and like, it'll be fine. I'll just put on 6 more, But I was actually just waiting to get killed. here. And the market, as usual, was more than happy to oblige, because then this happened. Boom, right? And so I almost don't need to really show you this. You can kind of imagine like kaboom. And I let this thing go for a while. I didn't take this thing off until the 6th of February. There were 2 or 3 of them, I think 3 of them that I took off early. The following Monday, I took this one off because I could kind of see the writing on the wall and was starting to realize, whoa, if this thing keeps coming down, Vegas is going to kill me. I'm not going to make anything. I really just made myself a sitting duck. So I took these things off early. I let this thing go a little long and it really went all over the place. And I don't even know why I kept this on because it was just killing me. And then I think I just let this thing expire out here. So, but it was a wake up call. You don't think about what this kind of thing is like until you experience it. I just wasn't taking the likelihood of it very seriously. Like I said, I just thought, well, these things will just die out here and I'll just lose a little bit and then I'll put new ones on, instead of thinking I could get run over on the downside. And that's certainly one way to do it, right? You can just trade a portfolio of stuff through all environments and struggle with some or all of them while you wait for the more favorable environments to come back, thinking that over a long period of time, your strategies will make money. But that can really hurt confidence. It can be psychologically damaging when it comes to trading, especially if you're a newer trader, but really for anyone. I don't know, maybe that fits some people's personalities. Maybe some people, roll that way and that's fine with them. But I realized that this definitely was not what I wanted to do. And so it was actually less damaging for me, really, and more instructive. And that's why it was such a turning point in my overall trading. It actually ended up being a positive experience. At the time, it was very painful. I had to sit back and reassess what I was doing and do some analysis and try to stay objective and all of that in the face of the emotion of losing money from these particular systems. I thought I'd reached a point where I knew what I needed as far as trading profitably and market neutral. And so it was really painful. But I realized that I just had to be more adaptive to changing environments. And I really had to start customizing trades for myself, really making sure that I understood them inside and out, and I made them my own. I realized how important it was for me to really start looking at these that way. So long volatility to the rescue again. And so what's funny about this particular moment in time for me, here's UVXY again. This is a different system I had. What's funny is that right at this exact moment, and I had kind of mentioned this, I had been focusing more on market neutral and swing trading as my main components. I was still trading volatility, but I'd sort of relegated it to third wheel status in my portfolio, that I'd decreased my risk allocation in it because I had such a love affair with market neutral, and now swing trading had come around for me as a profitable system. So I increased risk in the other things, and I think that's mainly because the market had just been going straight up. So even though I experienced that profit spike in 2015, you think I'd learned, what I should be doing. Even though I continued to trade volatility systems through 2016 and 2017, I started drifting more to those other things. And so, I had been trading long volatility, like I said, since 2014, 2015. Experiencing that nice equity curve since that time that was being achieved by adding that short vol element to sort of smooth it out, and keep that sort of upward drifting equity curve while taking advantage of the spikes when they would happen. And of course, I traded just short volatility profitably up to that point before adding long vol. But by the time the volpocalypse happened, I was kind of splitting the long and short vol systems out separately, working on them kind of separately because I wanted to see if they perform better in separate time frames. And I was kind of liking the idea of being both long and short volatility simultaneously. I was just kind of liking that idea. So I was testing them and pulling them off from time to time and doing different things with them. So option spreads, directional plays were kind of at the forefront. And then I got this wake up call, right? So at the time, this was one of the separate long vol strategies. And it's kind of funny too, I'd actually taken a short break exactly at this point from trading short volatility when this happened. But that said, the system that I was trading at the time that I would have been trading, it would have gotten me out before this craziness happened. Is that a guarantee? No. That's why you have to watch out for short vol. But the good thing is that, I wasn't trading short vol at the time, but it would have been fine even if I had been. So with my system. So this is that sort of the long vol system I'm talking about, kind of on its own. I had taken it, I'd ripped it away from short vol, and it was kind of by itself here. And I was working on that and kind of just hoping for spikes. And I just didn't want this thing to bring the rest of my portfolio down with it. I kind of zoomed in on this. It's a little bigger here. And so you've got, let's say you start off at, and the allocation was less. I think this is 20,000 every time a trade is taken in long UVXY. And so you start out about $5,300. The next slide, you make about what, 23,000? Yeah, about $23,000. And so that's over 100% again. And that's in what, a couple of weeks. And so again, I'd taken my road trips off. And I was again sitting back going, and it's like, hey, great, something can help, and so long vol provides another P&L boost, and so it reminds me of the power of this stuff. It woke me up to the importance of a hedge like this, the kind of profits that could be made from, these kinds of events. So it kind of pushed me back into these systems. Also, I realized the downside risk I was taking in market neutral stuff, and this was a big deal. So the Volpocalypse or Volmageddon, whatever you want to call it, forced me to realize that I had to adapt to changing market environments. I had to customize my trades for myself, really sort of start becoming an actual market neutral, actual trader instead of just trading people's systems. I really had to, okay, if I want to do this, I have to make them my own. These were big realizations and a turning point, but also I started really paying attention to that total risk in this discipline in market neutral, which is the amount you can lose. Yeah, and it's usually on the downside of the profile. So, I call it total risk because, if something crazy happens, they close the markets, and then a week later they open the markets, and the price, they open way down on the bottom of your profile. Well, you lose pretty much everything you put into that trade. And that started scaring me, and I started thinking maybe putting market neutral as my main component, through every possible market environment, no matter the changes, is not a great idea, right? So, duh, right? So I realized this, and it was a big deal for me. And a big sell-off will wake you up and make you sort of realize this kind of thing. But I really wanted to keep trading market neutral stuff, especially the road trip. I love that trade. I still love that trade. And so I just started focusing more on long volatility as a hedge. And I started thinking about, this is S&P versus VIX. Okay, so I started thinking about, is there a way I can take advantage of this price behavior? So this is the VIX, and you can see, obviously, and we all kind of know this already, it has a particular price behavior. It's big time mean reverting index, right? So, and it goes up way, it spikes way, it goes into orbit while when the S&P sells off big time. But you can see it goes up way more than the S&P goes down generally. So that's one thing. And then the other thing is it's very mean reverting, right? And the other thing is volatility products that attempt to track the VIX, like VXX, UVXY, TVIX, all these things that attempt to track it at different sort of time frames. They have their own price behaviors as well. And I talk about that in the course. So not only was I trying to figure out how to take advantage of just the straight VIX price action, but also the price behavior that these volatility products exhibited. And so that was a big deal. I started really working on that. And I started working on developing profitable equity curves and standalone long volatility strategies. And of course, it was Andrew Faldy who kind of was the first one who had a really good idea on how to do that. I think he gave a short presentation at some point that I saw. This was before Forma Financial. I can't remember what he was doing, but where he was working, who's working with, but he showed this, and I remember thinking, hey, that's a great idea. And so I talked to him about it, and I kind of took it and ran with it, and sort of started, getting more intense, putting more intense effort into this. But Andrew, of course, he's a smart guy, and so he sort of had the very beginnings of this. So this is kind of what I came up with. I worked and worked and worked, and it's $60,000 per trade, and I'll explain why I did this. And this is the profit. This is generally the equity curve I was experiencing in long volatility. from about this time, 2014, 2015 anyway, but I had to add that short volatility element to it at the same risk allocation in order to get this kind of a thing. So now I didn't have to do that. I figured out a way based on kind of what Andrew had been working on and presented of putting this together on its own. Now remember, this is a hedge, okay? This is basically a hedge. This is long volatility, just long volatility, going long UVXY. So having a standalone profitable equity curve is a big deal. I know that it draws down, it's going to. But I started thinking about, okay, if I'm not going to use short vol, because the vol apocalypse made us all very nervous about shorting volatility, right? It's something that I still recommend, even though the course talks about going short and building systems in short volatility. You have to be careful with that stuff. You don't want to put your net, your total, amount of money that you have in your bank account in that. Okay, you want to make sure that it's a smaller allocation in your portfolio. So not having to add short vol to this to smooth it out was a big deal. And I started to think about, oh, okay, well, maybe there are other things that I can start adding to this long volatility profitable equity curve to smooth it out and bring these drawdowns up, lift these up, and then the spikes are higher too when that happens, and not give away the spikes as much as if I can do that. So and keep in mind, this doesn't include the black swan, as I call it, of 2020, the big huge sell-off. I had not really even experienced the black swan yet. There were a handful of larger, deeper volatility or bigger volatility spikes up until where this curve ends. I hadn't, this wasn't part of this equity curve. So I started developing things and pairing them with long volatility. One of them was LVMN, as I called it, which stands for long volatility market neutral. It was a sort of a variant of the M3 that I had started trading. And it was, I sort of customized it, made it my own. It was more of a bullish strategy. And I paired it with long volatility, and it had a great curve. And that was the beginnings of the idea of, oh, okay, well, let's add some swing trading. Let's add some other stuff. And at that point, then I started thinking, what if I put most of my risk allocation in long volatility and less allocation in the other stuff? So I started leading with my hedge and my personal trading, and my conventional trades, the market neutral and the swing trading stuff, started to become the hedges for that. And I started sort of calling it, leading with my hedge. I didn't have to worry about making them main components at this point and stressing out and grinding it out while worrying about the next big sell-off. That was one big, upside to it. And I actually started to have a lot more fun trading the market neutral, not worrying so much about the total risk anymore, because I didn't have as much risk allocation in it. It wasn't my main thing I was doing, but I could still do it. And I wanted to keep doing it, and I wanted to keep trading my swing trading stuff. I have a lot of fun with that. These were really just used to fill in the UVXY reserve tank, so that, during these times, usually when you get these dips in the UVXY equity curve, it's because the market's going up, and these volatility spikes are I call them kind of false cycles. You get the volatility spike and then the crush. And so these are losing cycles. And, this system, I'm not going to say the system doesn't lose. It does, obviously. And you're going to draw down during longer periods sometimes of, price going up or sort of going sideways. But you can fill that in if you're watching your environment. You have certain other things you're doing. And I started doing that. Also with capital management of the actual UVXY strategy, once I started drawing down, I would actually add little by little amounts of risk allocation to UVXY. So I would juice up that next spike. And so using all of this together, that's kind of my idea for leading with my hedge. Okay. And so the black swan of 2020 happened. And this is another reason why I started to really believe in the leading with my hedge idea, because these things happen. You get these sell-offs. The S&P sold off 35% less than a month. The VXX spikes 480%. It's not even a leverage product. UVXY, which is a leverage product, spiked 1,150%. So they go up way more than the market goes down. And this thing happens. It's not like you're rolling the dice hoping that something will ever happen. At some point, there's going to be some event that causes fear selling, panic selling, pandemonium, things happening. You don't know when, and it could be longer periods that you're waiting for this, but this kind of thing, this just happens. And so I felt more confident running this kind of an approach because I knew it was inevitable, right? So here's this latest one. Here's the black swan. Here's the big, huge, sudden sell-off of February through March 2020, from the coronavirus scare, and which we're kind of still in. But you've got this long sort of, it almost looks like a drift up, but every day you're getting this volatility is going higher almost every day, and you're getting these gaps up in volatility. And at this point, I had taken most or all of my other stuff off, and I was just kind of sitting in this, and at some point just wondering, okay, when's this thing going to get out and how much am I going to make? Well, and I took profits during this time period. I was taking profits. I almost couldn't help myself. But I recommend, if you're going to automate this, stay in it, because the system captured 460%, right? So it starts here. Again, this doesn't go all the way back to 11. It starts about 2014, 2015. You start off at about 100,000 in this thing. It's a $60,000 allocation. A month later, you're up at 374, 375,000. It's a huge, huge event. And it's 460% if you stay with the automation, right? I was taking profits. I didn't quite make it up to these heights. Still made a lot, still got close. It was still a huge deal. It still validated what I was thinking. I was sitting there going, wow, this actually worked, And so my UVXY standalone strategy, using conventional trades to sort of add in and push the drawdowns up a little, get them up a little, turned into this, right? Boom. And so, it was like, wow, that was pretty darn mind spinning at that point. And at that point, I started realizing this could really be a good hedging option for other traders. I think this is something, even passive investors, I think this is something I need to kind of share with people and talk about. Not everyone automates though. So, I came up with the automated volatility trading course. So to give, the first video and a half, maybe a little more than half, navigates the TradeStation platform. Like I said, gives you the foundation for doing this. So you can use other ideas, you can code other ideas, and then it talks about the volatility products, and then it shows you how to build those systems out, gives you actionable trading ideas and strategies. So that it's a big deal. And so I want to nail this point home real quick before I finish, about how it can also help passive investors, and how it can also not take away your income during bull markets. So this is basically, these are charts. This one's going long VOO, which is that Vanguard Index ETF. It's just $50,000, starting at $50,000, and then you add whatever you make, and then you take it into the next year and trade it. So it's kind of compounding, not compounding, but with the long VXX strategy, adding it over here. Okay. So you're adding the long VXX, which makes, these aren't apples to apples, these two equity curves, by the way, because look at, 20,000, 50,000. So you're making more over here as you go higher. Okay. Because you've got this long VXX system. Now, again, long VXX is not leveraged like UVXY. So I've been hard pressed to find an equity curve by itself that gives you that really nicely uptrending equity curve with long VXX, but it still protects your portfolio. It's still going to spike like crazy, as you can see here. And so if you're a passive investor, you're just going long VOO, you make a little over $1,000 in 2011. Well, in 2011, if you added long VXX, you're way up. You're at like 38,000. So you've already got the jump. So even though you may be drifting a little bit down or sideways over the next couple of years as the market goes up, you're still ahead, right? You're still up on VOO. And then you're taking that ride. You're not giving away anything that you're making, and you're not giving away your profits or income. Okay. And so you're still making money, but this is the reason why you're really using this kind of thing to hedge, that this thing is always sitting there ready to help you, is this dip in 2018. If you're long the market, if you're long only, you're going to experience this, right? And so you're sitting there going, oh man, I went negative for the year in 2018. Well, this thing helped you stay positive, right? And so you're still going up, you're positive in 2019. It still helps you be positive in 2019. And then this is the really big one. You've climbed and you're happy, and all I've done is gone. And I know people I've talked to who are like, man, it's just been great. And it's sort of amazing to me that people don't realize that this is going to happen. And I understand it. I'm not making fun of them or being critical. It's just sort of the way our minds work, you know. My mind works the opposite, you know. This is going to happen, right? And it does. And so I'm like, well, I'd rather, even if I'm flattening out, or not flattening, but even if my curve isn't as, you know, it doesn't have the angle of this, I know this is coming. Okay. And it comes and it pushes you up above into another, you know, realm here. And then you're ready for that next sort of bull market to begin whenever it begins, or you're ready for the next, you know, big spike if that happens here. So, you know, this is a powerful concept. This is, you know, and you can change your risk allocations if you want to, you know. You don't have to lead with your hedge. You risk allocation is a preference, so you can decide, well, I'm not going to lead with my hedge because maybe that's a little, the results are a little too volatile for me. I'm just going to pull back my risk allocation and use it more of a hedge. It's still gonna at least, the very least, most likely flatten those long only dips out in your equity curve. You know, you're still gonna get some degree of protection. And in fact, while you're making money from the long only index ETF, it's gonna help that curve during those bull markets too. So you can kind of mix and match your risk allocation preferences. And there are other hedging concepts. You know, this certainly isn't anything new, okay? And I know that. I've traded a lot of hedging concepts. How many are going to give you, you know, the hedging concept, so protecting your portfolio, the huge amounts of money you can make during a market crash, as well as a standalone profit equity curve over bull market during bull markets. I'm not saying there aren't any. I'm just saying that this is a pretty powerful concept. I think it can be very helpful to, you know, active traders, passive traders, and that's why I put this course together. And I think I think it could be a very extremely helpful thing. So www.formafinancial.com is the website. I work with Andrew Faldy over there. Go visit that, learn more. You can also email me at preston@formafinancial.com. I'm very accessible. I always try to get back to people's emails as soon as I can and answer questions as clearly as I can. For Aeromir purchasers, for you guys in the Aeromir community, this is your link, okay, to go and look up and purchase this. And you will get that we're already offering a 30 days of free group mentoring to help you build out these systems. For Aeromir purchasers, if you do this within a week, then you'll get another month. So you'll get 60 days to help you really build out these systems, because we don't want to leave you alone, like I said, okay? We want to help you get this set up to your satisfaction if we can, okay? It's the automated volatility trading course. And again, to leave you with this, it's not just volatility. These are powerful, powerful systems that can make a big difference for you. They made a big difference for me, but you can also take what you learned from the course. You can automate other ideas as well. If you want to come into the group mentoring and talk about other ideas, then we'll talk about that, you know, and we'll see if we can figure some things out for you that work for you, and try to get you something, a successful system and another skill set that can be a big deal for you. So that is it. So Tom, thank you for having me today. I'll send this back, or I'll keep this up as long as you'd like me to keep this this page up.
Yeah, well, thanks, Preston. Jackson Clare had a question. He said, "What's the difference between SPY and VOO?" VOO.
Oh, right. Well, VOO you know, issued by different companies. Obviously, VOO is Vanguard, and you know, I don't know if there's a difference with the dividend. I mean, they each pay dividends. I think the SPY is going to be much more liquid because it's one of the most liquid instruments that you're going to trade, tracking the S&P. The VOO is very liquid, and I don't know that I'm not sure. I don't think it's leveraged. I don't think the VOO is leveraged. I believe it's just 1-to-1, but it's just, I just used VOO because if you're a passive investor, you know, I've talked to people who trade that or who just buy that, and it's because of the dividends, generally dividend growth that you get with it, and instead of buying the SPY. That's why I used it. So.
Well, great. Well, that's the only question. So I
Okay.
guess people understood what you were talking about.
Good. That's good. And if not, they can email me if they have any questions. I'm happy to talk to them and answer any questions they have.
And I'll put that in the description, and not the one that goes on YouTube, but one in the members area, so that
Okay.
people can. I don't want you to get a lot of spam emails. So,
Great. That would be good. Yes. Excellent. Thank you, Tom.
all right. Well, appreciate it, Preston, and yeah, take advantage of this. It's a nice offer. I looked at the video on it, the page where you buy it. It looks pretty good. So.
Yes.
If you're
Yes.
interested in automated trading at all, 2 months of hand holding is a pretty good offer. So,
That's yeah. Yeah. There is another question. It looks like from Jack Sinclair. He said, "Why would you ever move away from Fort Myers?" I completely agree, Jack. I wish I was in Fort Myers right now, but I actually, Andrew is the one in Fort Myers, and I live near Kansas City. And so we work together remotely. But yes, I would love to be and live in Fort Myers. Yes.
yeah, we thought about moving to the coast, but my wife Gabby has some arthritis, so Colorado Springs with very low humidity was much better for us. But
Right.
we do love the ocean, but the mountains are great too.
Yes.
So,
Yes. Yes. No, I'm totally with you. Yeah. I'm a big beach fan. And so Florida. Yeah. Oh, and so Alan asked what size account needed to trade this. You don't need a large account, Alan. As far as an account size, whatever you're trading, I would always recommend looking at testing it and finding out how much the drawdowns are. Okay. That's always going to tell you what size accounts you need for anything. So, and it's really easy to do that with automated stuff because you can test years and years back and then get in seconds you can get all these different trade parameters, and it'll talk about the largest losing trade that you had as well as the largest drawdown. And so it will depend on your risk. You can sort of mix and match risk allocations in your testing. And let's say you've got a small account and you only want to allocate $5,000 to it. Well, then put $5,000 in your test, run it, and then see what your biggest drawdown is. And then I would go from that. You need at least probably double that to run the strategy. And I would always go from risk and how much you lose in a system to determine your account size.
makes sense.
Excellent.
All right. Well, I think that's it. So, why don't we? No need to keep people here since we're done. So, I'll go ahead and end the recording, get this posted, and put the links in the description so everybody can take advantage of this if they want to.
Excellent.
I think we can probably paste it in the chat too, just since people are here.
Sure.
Let's see. I've got Andrew's email. I'll just copy that again.
Oh, great. Yeah.
There we go. Okay, so there's the link. So you don't have to wait if you want to go there. It's pretty easy to remember. So yeah, take advantage of it if you're interested in automated trading. And Preston, looks like you've done a lot of great work. So thanks for
Thanks, Tom.
coming on and showing us.
Thank you, Tom. I appreciate you having me. Everybody stay healthy and safe. And I hope to see you in mentoring. Thanks, guys.
Absolutely. All right, thanks a lot, everyone. We'll see you next time.